I just made $780 this week, actually right now, to be honest with you, by selling two different options. And the cool thing about this is I didn't have to guess the market. I didn't have to buy some fancy course from some guru out there. And I didn't have to stare at charts all day. I promise you, I literally got paid to wait to buy Amazon shares, and I got paid again to hold shares of SPY. You can't beat this. You're about to see two real trades that I just placed into the market right now. I placed a cash secured put on Amazon, and I sold a covered call on my SPY shares. And man, listen to me. This is the exact strategy that I use every single week to generate consistent cash flow and to minimize risk in the market. And today, I'm gonna show you every single detail of each one of these trades. If you're just tired of sitting around and watching the stocks go up and watching them go down and watching them go up and watching them go down, if you're just tired of that, man, because that does get tiring after a while, check this video out. Check this strategy out. I promise you, you're gonna learn something here. It is time for you to become the one getting paid. And no matter what direction the market moves, you're gonna get paid if you do the strategy. So let's go ahead and break it all down, and let's start off with the first trade I made here with Amazon. Once again, first up on the list, we have Amazon. I sold two put contracts on Amazon today, and each of these has a strike price of $222.50, and they're both expiring on August 1st. Each one of these contracts paid me $2.23. So that is a grand total of $446 in premium collected instantly once these trades went through. Now, I want you to understand this. This is the key part of this trade right here. Check this out. My break-even price on this trade is $220.27. That's the strike minus the premium that I collected. If Amazon does go below my strike price and I do have to purchase the shares, my true break-even price on Amazon is as if I purchased the shares at $220.27. Amazon is above $232 right now. I have no problem collecting 200 shares of this stock for this discount. So you might be asking yourself like, Johan, why would you sell two puts on Amazon? What if the price goes down, or what if, that's a lot of money to put into one stock? Let me explain this to you real quick. Amazon right now is trading at about 232 bucks and change. If Amazon stays above my current strike price of $222.50 by the expiration date next week, August 1st, I keep the full premium and I walk away without buying the shares. But if I do get blessed, if God blesses me with the opportunity to buy 200 shares of Amazon, I'm going to be completely ecstatic. I don't know if this microphone would hold down the excitement. But if I'm able to buy it at $222.50 how I want to buy it, I'm going to have 200 shares of Amazon. What I would do with these shares is I would start selling covered calls on these shares. I would continue to sell options on these shares, just how I've done in the past. If you saw that previous video that I have on the channel, I recently had 500 shares of Amazon that I got assigned a couple weeks ago, and I sold a couple covered calls on them, and I ended up getting them called away. If I get those shares back now, if I get 200 shares back, I'm more than happy with that. I will continue to generate consistent weekly income by doing the wheel strategy on these shares. And at the end of the day, Amazon is a great company. They have earnings coming up, so I know now it's a little shaky for people to start playing with options. If you want to own the stock long-term anyway, it doesn't matter if the earnings is coming up. Regardless, if I do get assigned these shares, I am collecting them at a discount. I will have a break-even price of $220.27. The stock is trading above $232 right now. You're getting it for $12 cheaper. Give me the shares. So when you look at this contract, the core of selling put options, you basically get paid to wait. You control the entry price. As you can see, I'm controlling where I'm going to buy the shares at. And you basically generate weekly income without having to purchase the shares. So you don't even need to own the shares to generate weekly income. A lot of people do the buying and selling. The only thing is you have to get rid of the shares and collect the share price appreciation if you trade that way. You have to look at charts. You have to start doing all this technical analysis. This, you just collect the money and you wait. It's as simple as that. And before we move forward, if you guys can please do me a favor, subscribe to the channel. A lot of the people that watch my videos are not subscribed. For whatever reason, I'm not sure what that's about, but I have like 55% of the people that watch these videos are not subscribed. Go ahead and subscribe to the channel. And also, if you enjoy this type of content, give me a big thumbs up and smash that like button because it does help the YouTube algorithm get this video out to the people that are looking for this type of content. And it does help people figure out how to do these types of trades, right? And at the end of the day, it does help my little channel grow, and I highly do appreciate it. Thank you for that. Let's get back into it. So moving on from that, let's go ahead and jump into the second option that I sold for the day. This was a SPY covered call. I owned 59 shares of SPY. I had a pretty good average on that. I needed 41 shares to get to 100. I had some cash in the account. I said, you know what? I'm going to go ahead and buy the 41 shares and get that 100 share overall accumulation so I can sell a covered call. So once you have 100 shares in your account, you can sell a covered call on those shares. So the strike price that I chose for these 100 shares was the $639 strike price. It's also expiring on August 1st. I collected a premium on this trade of $3.34, which once again, if you're new to options, remember you have to multiply that times 100. That equals $334 in income, just like that for the week. And again, this option expires on August 1st, but the money, that money that you collect on that premium goes into your account right away. Once the trade executes, that money's in your account. You could literally grab that money and go buy shares of whatever other stock you want. My break even on this SPY trade is going to be $642.34. This is my strike plus the premium that I collected. Essentially, if I do end up selling these shares, I really sold them for a price of $642.34 per share. Now think about this. The market right now is at all-time highs. We're hitting all-time high after all-time high after all-time high. I am completely fine getting rid of these shares at $642.34. You know why? I'm going to tell you why. I'm going to tell you why. If I get rid of these shares at this price, I know for a fact I'm going to have another window to get back into this position. I will 100%, I will change my name if I never have another window to get back in at $642, okay? So I know for a fact, since we're at the top of the top of the top of all-time highs, I will have another window to get back in if they do get called away. So I have no problem with that. If the market tanks a little bit and we go through some correction because of the tariffs and all the talk with Trump talking about tariffs and all these other things going on in the market, if it does go down, I'm fine. I hedge my position with the $334 that I just collected. Pretty decent money. So let me give you a little recap with this SPY trade here specifically, okay? If SPY closes below $639 per share, I keep my shares and I keep the full premium. I don't even have to sell my shares to anybody. I get to keep them. And if for whatever reason, SPY continues to climb up and it goes above the $639 strike price by the expiration date, and I do get my shares called away, I will sell my shares at $639. I will make a big profit on the share appreciation as well because my average cost per share is way lower than that. So I'm going to make a big appreciation on the share price and I'm still going to collect the full premium. So what I'll do is I will sell cash secured puts on the SPY at $639 where I sold it to get back into the play. So if I sell a cash secured put in the future on SPY at $639 and let's say I collect another $350 for that, that is another $350 that I basically added to this trade right here. Does that make sense? If for whatever reason this doesn't make sense, please drop me a comment down below. I will be more than happy to jump into the comments and explain it to you step by step. So guys, like when you sell covered calls like this is the beauty of selling a covered call. You generate income from the stocks that you already own. You're basically selling at a price that you want to sell the shares at. So it's the same thing as the puts that I sold with Amazon. I'm selling this at $639. That is the price that I want to sell the shares at. I'm completely fine getting rid of that because I know, again, I will have another window to get back in that level. And then the third thing I wanted to mention, another great part about this is that you're going to basically generate consistent cash flow if the stock trades sideways. So if the SPY starts to bounce around between, 637 and 630, 629, 636, drops back down to 625, you're going to generate consistent income while you're just holding your shares. You're basically leasing out your shares. So the cool thing about this is the premium that you collect, you can grab that premium to buy you even more shares of SPY that are going to pay you a dividend. Or you can put this into another dividend stock and start building that position little by little. But this is definitely a way, if I had to say, this is the easiest way to minimize risk in the options market. In the market overall, to be honest with you, because when you sell options, you're basically choosing the stocks that you like anyway. Does that make sense to you guys? If it doesn't, again, drop me a comment down below and I'll dive into it in the comment section with you. But you're doing this with the stocks that you want to hold, the stocks that you want to sell. So I don't mind selling SPY. That's why I put it up for sale. Now, do not do this if you never want to sell the shares. If you're one of these people that you're like, hey man, I never want to sell my shares of SPY, or I worked hard to put this 200 shares of Google or 200 shares of Amazon in my portfolio. I never want to run the risk of getting them called away. Do not do it because it could run, the market could rip and you can get those shares called away. You could probably get back into the position, to be honest, if you pick a strike price that's above the current price, like well beyond the current price, you definitely can. But if you don't even want to deal with that, you don't want the headache, don't do it. This ain't for you. So let's tie both of those trades that I just did. Let's go ahead and tie them together. Let's tie those two trades together and let me explain this to you. When I sell a cash secured put on a stock like Amazon, that put option that I just sold helps me enter that position, but I get paid up front. It basically helps me enter a position that I don't mind getting into, but I get paid up front. If I enter the position, great. I would love to own the shares of Amazon. If I don't, I'm not bothered by it either because I'm collecting the premium instantly up front. If you're more of the person that you're like, hey, I really want these shares right now, then I suggest buying them straight up or selling a put option super close to the current price so you have a higher probability of getting assigned the shares, and then selling covered calls in the future way out of the money. But if you don't care whether you own the shares or you don't, you just want to make that cash flow every week consistently, this is a good way to do it. So now going to the second part of this trade, the SPY part. Once I actually own the shares and I have enough shares to sell a covered call, I'm going to flip it around. I'm going to sell covered calls on those shares, just like I'm doing right now with the SPY. Not only am I going to make the appreciation difference from the share price going from, 580 something to 639, but I'm also going to make that consistent weekly cash flow with the premium that I collect. And then again, if I don't sell the shares, I just collect the premium and I keep it moving. I continue reducing my average cost basis on these shares because I continue to collect premium on a weekly basis. The more premium that you collect on a weekly basis, the lower and lower your cost basis actually is because it's less and less of your actual money that you have into the position. So this two-part system that I'm doing here, there's different stocks involved, but this is basically called the wheel strategy. And let me show you exactly how this works. So basically, once you have enough money to buy 100 shares of a stock, if you want to start collecting that options premium, you're going to sell a cash secured put on that position, on that stock. So if you wanted to do this with Amazon, you're going to need about $22,500 to do this with Amazon. Once you have that money, you're going to sell the put option. Hopefully you get assigned. Once you get assigned, you kept the premium, you now own the shares, you're going to sell covered calls. That's the second part of this wheel strategy. Once you sell the covered calls on those Amazon shares, you're going to sell them above your strike price of what you bought them at, $222.50, I'm sorry. And once you sell them above that, if you want to get rid of them pretty quick, I would do it tight. I would keep it at 225, 227. Once they do get sold, you're going to collect the premium. You're going to get the difference in the share price appreciation, and you rinse and repeat. You could do it with the same stock. You could get that money, put it into another stock. You have options here. No pun intended. This is a perfect way to generate weekly income while staying engaged with your long-term positions. And if you don't want to run the risk of selling your shares and you want to make this as difficult as possible to not sell, go way out of the money. Go to a price that you know that stock doesn't move often. Does Amazon often move $35 in a week? Not really. You know what I mean? Like, even if you collect $9 that week, so what? You're getting paid a $9 dividend for doing absolutely nothing, just holding the shares that you want to hold anyway. $9, they add up pretty quick. Every week you collect $9. That's a pretty good chunk of change, believe it or not. 9, 18, 27, 36, 45, 54. In 6 weeks, you have $54 that you did absolutely nothing for. And it's basically a dividend. It's a $54 dividend in 6 weeks just for holding shares of Amazon. Pretty good in my book. So whether you're just getting started or you're looking to level up your options game, remember this. You don't need to gamble with options. You can literally use options to your benefit, and you can use them strategically to manage your risk and create cash flow. If you found this video helpful, once again, do me a favor, smash that like button if you haven't, subscribe to the channel if you have not either. And let me know down in the comments below if you enjoy this type of content, if you enjoy watching me put these trades out. This is what I do on a weekly basis, guys. I generate money from this. This essentially helped me buy this house that I'm sitting in right now. So I'm super thankful for learning this strategy. It does help me hedge risk in my portfolio, and it does also help me generate consistent monthly income. So yeah, that's pretty much it for today. Thank you for coming to hang out. If you have any questions, comments, or concerns, drop them down in the comment section below. I love getting in there with you guys and chatting it up. And without further ado, I will see you on the next one. Peace.